What is Goodwill? In this video, I introduce this intangible asset, explain how it is created in an acquisition, and share some statistics about it. Let's refresh our understanding of intangible asset recognition. Intangible assets are assets that do not have a physical nature, but are often a very important source of strategic advantage for a company. The intangible assets are capitalized and recorded on the balance sheet if they are purchased from an external party. On the other hand, if they are created internally through the process of research and development or advertising and marketing, they are typically expensed. Why do we take this conservative approach of expensing the internal generation of intangible assets? Is because there is a high degree of uncertainty whether any specific outlay associated with that internal process is going to lead to a direct benefit in the future. How are intangible assets purchased? They could be purchased individually. So a company can go out and just buy one specific patent or buy a portfolio of trademarks, but they could also be purchased in a merger and acquisition transaction. And in this video, we are going to talk a little bit more about the scenario where you are buying an entire business. So let's think about a simple example. Let's suppose that we have a furniture manufacturer that acquires a lumber company, and the lumber company has the following assets. There's inventory worth $35 million, there's property, plant, and equipment worth $100 million, and there is timber licenses and other identifiable intangibles, such as maybe trademarks or something else, and they are worth $15 million. So in total, the value of the assets that the manufacturer would be acquiring is $150 million. But if you're acquiring a business, typically they do have some liabilities, and now their liabilities is also your liability. So let's suppose that there is $50 million in terms of bank loans, etc. So the net assets minus liabilities, the net identifiable assets, the ones that we can separately identify and measure, are $100 million. Now, let's suppose the furniture manufacturer is actually willing to pay $130 million to acquire this lumber business. Why would they be willing to pay $130 million when the net assets that they are acquiring are only worth $100 million? And the answer is, when you're buying a business, you're buying more than just a basket of goods. Yes, there's inventory, property, plant, and equipment, and timber licenses, but you're actually buying more than that. Maybe through the vertical integration, you're now securing your lumber supply. So there is a cost advantages, there's synergies to have one of your suppliers integrated in your business. There is less risk, more predictability in terms of your supplies. It could be that this is now leading to reduced material cost, reduced transportation costs, that you can structure the manufacturing in a more optimal manner. You could be gaining an experienced workforce, both in terms of the management and in terms of the rank and file employees. It could be operational expertise. So there is a variety of potential reasons why this business is attractive to you, which actually extend beyond the specific assets that we have listed here that they actually bring to the table. And in this situation, what are we going to call this difference, the $130 million minus the $100 million? So that extra $30 million, that premium because of these additional factors, what is that going to be called? That's actually exactly what the goodwill asset is. Goodwill is the excess of the acquisition price over the fair value of the separately identifiable assets and liabilities acquired. So what are you willing to pay, which is beyond the specific assets minus liabilities, which are now going to be on your books as a result of the acquisition. And as I just mentioned, this is going to reflect future expected benefits that cannot be separately identifiable. So you cannot put your finger, you cannot reliably measure things like synergies, but you have an expectation that these companies working together, the human capital, the reputation, maybe advantageous geographic location, supply chain security, If you're acquiring a competitor, there could be a market advantage in terms of not going after the same customers. So there is a variety of reasons that go into this purchase price premium that are going to be included in the asset goodwill. Importantly, goodwill is recorded only in a situation where an entire business is purchased. That could mean a company or it could mean a unit or division, but it needs to be sufficiently distinct where that unit or division can actually operate as a standalone company. Goodwill has an interesting incongruity in its nature. On one hand, it is a very mechanical calculation. Arithmetically, it is just a residual. When you go out and you think about the company that you acquired and you come up with the fair values of all of the assets and liabilities, whatever is the purchase price that you have negotiated between the buyer and the seller, goodwill is just going to be the purchase price minus those assets and liabilities. So it's not really subject to discretion, to the judgment in the same way that we talked about. It really is a residual of the purchase price. However, at the same time of being very mechanically calculated, it's actually really difficult for us to put our finger on what goodwill is. It is, quote unquote, the most intangible of all of the intangible assets. And that's because this is everything that's remaining after we take into account all of the assets that we're acquiring, including the intangible assets. Keep in mind where we started our discussion, intangible assets are not recognized on the balance sheet if they are internally developed. That means that if you're buying a company that has any of these categories of intangible assets, technology-based such as patents, customer-related such as customer lists, marketing-related such as trademarks, contract-based, licenses, franchise, non-competes, artistic-based, copyrights, those, if they're developed internally, are going to be missing from the balance sheet. And that's fine, because what I just mentioned is that when you are acquiring a business, you care about the fair value of the assets that you are acquiring. So you don't really focus on what that business had those assets on their balance sheet at. Instead, you do your own due diligence and you think about what is the value to you of these things. And even if they had internally developed intangibles that were zero, that were missing from the balance sheet, you would give them a fair value as long as you can separately identify them, as long as you can predictably come up with a valuation. And for all of these things that I mentioned, patents, copyrights, customer list, there are valuation methodologies that would allow you to come up with an estimated value of these. Some of these are based on future cash flows, so discounted future cash flows. Some of those are based to what is it worth to you to have this asset instead of to rent the relief from royalties? There's a variety of methodologies. And goodwill is the most intangible because it says, after I have taken into account all of the assets that I have acquired, both tangible and intangibles, that I can separately identify, I'm still willing to pay extra. I'm still willing to have this purchase premium that I am doing in order to make this deal go through. And that's because of these other kind of softer factors, including synergies and human capital. Goodwill is a non-transferable acquisition-specific asset, meaning that once you have it on your balance sheet, if someone else buys your company, they're going to ignore that old value of the goodwill entirely. And goodwill for each acquisition is calculated from scratch, taking into account the identifiable assets and liabilities. This is probably a little bit vague at this point, so let's take a look at an example from real life that builds upon our furniture and lumber company example. So several years ago, IBM bought Red Hat. Now, this is the balance sheet of Red Hat from the last financial statements that we have where they filed as a public company before they were acquired. This is in millions. Let's take a look at what they have. They have some current assets, cash, investments, accounts receivable. They have property, plant, and equipment. Bottom line, their total assets are about $5.5 billion. They also do have liabilities of about $3 billion. So their net assets minus liabilities, are actually a little bit under $2 billion. Now, IBM acquired them for $35 billion. Why do we have this distinction, this big difference between what IBM is willing to pay to get their hands on Red Hat and what Red Hat had on their balance sheet? First is our general limitation, which is the balance sheet is largely a backward-looking document, so it doesn't capture the fair value of assets and liabilities. It doesn't capture the expected benefit of assets and liabilities It only captures their historical cost. Here we have disclosure from IBM's 10K after the acquisition. And if you do a large enough acquisition, then the company is going to disclose subsequently something called the purchase price allocation table, meaning they will say, hey, I paid $35 billion for this company. This is exactly what I got for this $35 billion. They will walk us through the assets that they have received as a result of this acquisition. And we can see that some of these assets match pretty closely to what is on the balance sheet of Red Hat. So for example, IBM says we got current assets of $3 billion. Total current assets were just about $3 billion on Red Hat's balance sheet as well. And that is because of the way that we have accounting treatment for these types of assets. Now, we do have some disconnect starting with long-lived tangible assets, and that's because, again, for example, for something like property, plant, and equipment, you will carry it on your balance sheet at depreciated cost. So cost minus accumulated depreciation. But when IBM takes the possession of property, plant, and equipment of Red Hat, they're going to think of this as a fresh slate. They're going to think of this as, I don't care how much you bought that land or those servers for. I'm only going to be concerned about what is the current fair value of this land and servers, and I'm going to add it to my balance sheet at the price which is assumed to be the current fair value. So there is some possibility of disconnect between the cost basis of those assets and the fair value which we're adding them at after the acquisition. Here where we see really, really large differences, the internally generated intangible assets. If we go to the balance sheet of Red Hat, we see that they have almost no intangible assets. It's less than $200 million. Now, IBM, on the other hand, assigns $7 billion to client relationships, $4.5 billion to completed technology, and $1.7 billion to trademarks. Now, all of these intangible assets are internally developed, which means that as the company was actually spending R&D and other operating costs to just develop these things to maintain relationship with customers, etc., they were expensed, they were hitting the profitability. They never showed up as assets on the balance sheet. So we see them really lacking here. But on the other hand, they are valuable to IBM and they are acquired externally in this situation. So they're going to identify them, they're going to value them separately, they're going to add them to the balance sheet. Here we also have some interesting information about the expected useful life of these assets, so we can think forward to what the amortization expense is going to be. If you haven't watched the intangible assets video, I really recommend you go and watch that for general treatment of intangible assets, various disclosures related to intangible assets, and discussion of the amortization expense as well. And here we have the second big reason why we have such a large disconnect between the net assets on the balance sheet before the acquisition and what IBM is willing to pay. The goodwill that they're adding to their balance sheet as a result of this acquisition is $23 billion. How did they calculate $23 billion? Well, the purchase price is $35 billion. How do we come up with the purchase price? It's really a negotiation. IBM wants to buy Red Hat. Red Hat investors, the shareholders, want to be compensated fairly for giving up the control to Red Hat. So there is a negotiation and the two parties come up with a fair value price. So the $35 billion is the result of this negotiation. Again, we're ignoring the old balance sheet, but we're thinking about IBM went and did their own due diligence. How much are we getting in terms of cash, accounts receivable, property, plant, and equipment, intangible assets? So all of these things are worth $17.6 billion. So that's the numbers they came up with, is the basket of assets that they're receiving. They're also taking on liabilities of $5.6 billion, which, by the way, the liabilities you'll notice are also bigger than the book value of the liabilities on the balance sheet before the acquisition. And that has to do with the potential distinction between the accounting for liabilities that we will cover in future videos and what the fair value of these liabilities to IBM are. If we subtract out the fair value of liabilities from the fair value of assets, the net assets that the IBM is getting is $11.96 billion. They're willing to pay $35 billion. So mechanically, the arithmetic residual, $23 billion, is going to be called goodwill. That is the asset goodwill that is going to go on to the financial statements of IBM. You might notice that Red Hat did have a goodwill on their own balance sheet. What happens to that goodwill? It goes away. The fact that Red Hat had their own goodwill on the balance sheet tells us that they did their own acquisitions in their history. At some point previously, Red Hat bought other companies, and as a result of those acquisitions, they had this residual purchase price, which they have called goodwill and compiled in this long-lived asset. Again, that goodwill is not the same goodwill that is calculated here. Goodwill is acquisition specific. How big is goodwill typically? Obviously, we saw for IBM, that was a really big number. That was a little bit on the larger side compared to maybe what we see as averages. Here, I pulled together some statistics about goodwill from a big data sample of acquisitions from 2003 to 2021. These are not all acquisitions in the United States, but these are fairly good representative size of acquisitions of public U.S. companies. And we see that the purchase price, so how much you're paying for a company, has remained fairly stable. They go up a little bit in the later years. And goodwill as a percentage of purchase price is on average about 30 to 40%. It does differ a little bit. We see that it's higher in the more recent years, surpassing 40%, nearing 50%, which is actually a really large number. So 30 to 40% of the purchase price is allocated to these things that we can't separately identify, but we say they're valuable to us. How big the goodwill is as a percentage of the purchase price does vary by industry, by the type of company that's doing the acquisition. For technology, the goodwill tends to be a bigger portion of purchase price. So the light green bar is the median, and the darker green is the 75th percentile, and the really dark green is the 90th percentile. So kind of nearing towards the extreme, the right tail distribution of the goodwill as a percentage of purchase price. So even in terms of the median, we see that for technology, the average is above 50%, so not the 30 and 40% that we see on the overall pooled sample. For some other industries, it's much smaller. Financial services, we don't actually have a lot of goodwill. Yes, there's the tail end. On the 90th percentile, we have a lot. But in terms of the median and the 75th percentile, because a lot of the acquisition of financial services is really focused on the investment portfolio, it's not nearly as much about things like synergies and human capital and know-hows. For that reason, not as much of the purchase price is allocated to it. Healthcare, especially pharmaceutical, is like technologies, a little bit on the higher side, but it is overall interesting that we see this distinction among the firms. Another way for us to think about the magnitude of goodwill is how big is it if we look at an average balance sheet of a U.S. company. 80% of U.S. public companies have goodwill on their balance sheet. Here I looked over the past about 20 years, all public companies with some minimum size requirement, and that tells us that 80% of U.S. public firms grow through acquisition to at least some degree. Goodwill as a percentage of total assets is about 10% for both the largest U.S. firm, the Standard & Poor's 500, and if we look at the entire population of U.S. firms. And if we look at goodwill as a percentage of total equity, just as a refresher, what is equity? It's assets minus liabilities. We see that it is nearly 50% for Standard & Poor, for the big firms that do a lot of acquisitions and they have accumulated a lot of goodwill, and it's a little bit smaller, but still a really large number for the full pooled population. So goodwill overall is a really large asset in terms of the composition of the balance sheet. Here's an example of a company that's not a very large company. It's not in the Standard & Poor's 500, but it is a good example of a company that has really placed a lot of stress on growth through strategic acquisitions. This is the Quest Diagnostics, the labs. And if we look at their most recent 10K from 2025 fiscal year, we see that their total assets are $16 billion. And of that, $8.9 billion is goodwill. So more than 50% of their total assets are from goodwill. If we look at their total equity, which is assets minus liabilities, which is $7 billion, goodwill is actually over 100% of their total equity number. And this is actually not surprising. If we look at qualitative disclosure that Quest provides to us, we see that this is their operational strategy, generating growth through value-creating, strategically aligned acquisitions using disciplined investment criteria. And the numbers that they give us are quite large. Their goal is to grow revenues by 1 to 2% through acquisitions. So this is a company that has placed more stress on external growth, acquisition growth. They buy a lot of smaller laboratories. That's how they expand, as opposed to maybe putting as much stress on organic growth as some of the other companies. What happens to goodwill after we recognize it on the balance sheet? First of all, goodwill is considered not to have an ending useful life, so it is an indefinite life asset. Now, that has actually not always been the case. Before 2001, we did see amortization of goodwill, but since 2001, we have the treatment that goodwill doesn't really expire, so as a result, it is not amortized. And it's actually an interesting debate that the regulators do go back and forth in terms of should goodwill be amortized, and if it should, over what time period. So under the current guidance for the past 25 years, we do not amortize goodwill. We don't have an expense associated with the usage of this goodwill, but it is required for companies to evaluate the goodwill for impairment at least annually. And if the goodwill is found to be impaired, which is really an indication that the acquisition is not working out as was intended, then a goodwill impairment charge, a write-down, is going to be recognized on the income statement, and the goodwill will be reduced on the balance sheet. In one of the future videos, I will talk about impairment testing for both tangible and intangible assets, both those with finite useful life and indefinite useful life, because all of those categories are required to be evaluated for impairment. And finally, the big question about goodwill. Is it actually good? Is it an indication of a good acquisition? Is it an indication of a problematic acquisition? And unfortunately, I'm not going to give you a definitive answer because evidence suggests that it is a mixed bag. On one hand, goodwill is definitely reflective of the expected economics of the combined entity. If we look at the survey done with a lot of portfolio managers, with a lot of analysts from the CFA Institute, majority of them looking at the performance of those acquisitions and purchase price allocations agree that goodwill is an asset. It is reflective of those forward-looking benefits like synergies, like human capital, like expertise, like market integration that we have talked about. On the other hand, we also have academic research, and plenty of it, that shows that goodwill often captures things that are not really desirable, things like overpayment, overly optimistic expectation that ultimately do not come to fruition, and also the relative bargaining dynamics of the acquirer and the target. In situations where the market is hot, where there's a lot of acquisitions, so the acquirers are forced to pay a little bit extra, we are generally finding more subsequent goodwill impairments, suggesting that goodwill was really kind of a rosy colored glasses and the purchase price is not reflective of the true value of the acquisition. There is evidence that the higher the amount of the goodwill, the more likely we are to see a goodwill impairment. That doesn't mean that every acquisition with large goodwill is going to see that. That's just a statistical relationship that it definitely is a complicated asset, and it is warranted that if you see an acquisition with a large goodwill, it's important to keep an eye on the subsequent performance, the subsequent integration, and in whether the future performance is going to match the expectations. I hope you enjoyed this introduction to the most intangible of intangible assets, goodwill. And if you like the video, then please like, subscribe, share it with anyone who is going to find a discussion of financial accounting useful. And I'll see you in the next one.